Welcome to The Explainer. Today, we are diving deep into a topic that, honestly, can seem a little intimidating, but it's absolutely crucial for understanding how a company really works: taxation.
So, let's kick things off with a real head-scratcher. Have you ever looked at a company's glossy annual report, seen a massive profit number, and then found out that the number they show the tax man is, well, completely different? How is that even possible? It seems a bit weird, right? Well, stick around because we are going to solve that exact mystery today.
We're calling this one The Tale of Two Profits. Our mission? To uncover the real story behind a company's tax bill.
Okay, so on one side of the ring, you've got accounting profit. This is the number for the shareholders, the investors. It's calculated using accounting rules, and it's all about showing off the company's performance. But on the other side, you have taxable profit. This one is calculated using the government's tax rules, and it has one job: figuring out the tax bill. The entire puzzle we're solving today lives in the gap between these two figures.
Now, if you look at a financial statement, that total tax number isn't just one monolithic thing. Nope. The accounting standards break it down into two key parts, something called current tax and something else called deferred tax. If you can get your head around these two, you've cracked the code.
Let's start with the easy part first, shall we? Current tax. This is the most straightforward piece of the puzzle, and it's probably what you think of when you hear the words corporate tax.
To put it simply, current tax is the company's tax bill for this year, based on this year's taxable profit. It's the check they expect to write to the government for what they did this period. Sounds simple enough.
But you knew there had to be the twist, right? Even the simple part has a little complication. See, the current tax figure you see in the reports, it's usually an estimate. The final, signed, sealed, and delivered number that's agreed with the tax office might not be finalized for months or even years. And that means adjustments are coming.
And this is a perfect example of what happens when those estimates are a little off. Take a look here. The company's estimate for this year is $180,000, but notice that line right above it, under provision? That's $15,000 they came up short from the previous year's estimate, so they have to add that shortfall to this year's bill. The total tax expense isn't just the new estimate, it's the $180,000 plus that $15,000 correction from last year. Total hit, $195,000.
Okay, so that's the tax for right now. But what about that second, much more mysterious character in our story? It's time to talk about deferred tax. This is the hidden clue that explains, well, everything.
All right, the official definition sounds a bit dry, I'll give you that. But listen to the key words here: future and already happened. That's the whole game. Deferred tax is all about recognizing a tax bill or a tax break that's coming in the future, but it's because of something that happened today. It's purely a timing issue.
You know, the easiest way to think about it is like a tax IOU. It's an IOU between the company and the tax office. Sometimes the company owes the tax office money down the road. That's a deferred tax liability. And other times the tax office is going to owe the company a tax break later on. That's a deferred tax asset. It's this IOU that makes sure everything balances out over time.
So, let's get right to the point. The only reason deferred tax even exists is because of those differences we talked about: the gap between the accounting profit for shareholders and the taxable profit for the government. Deferred tax is the bridge that connects those two different worlds.
And the fancy accounting term for these mismatches is a temporary difference. It pops up when accounting rules and tax rules just don't see eye to eye on the value of something. You know, a classic example is a company buys a new machine. For its shareholders, it might depreciate that machine's value nice and slow over 10 years. But the tax rules might say, hey, you can write off a huge chunk of that value in year one. That creates a temporary difference that has to be tracked.
So how in the world do you calculate this tax IOU? It's actually a pretty simple four-step recipe. Step 1, find the value of the asset on the company's books. Step 2, find its value according to the taxman's rules. Step 3, find the difference between those two numbers. And Step 4, multiply that difference by the tax rate. That's it.
Let's walk through this example for year one. It's easier than it looks, okay? Step 1, the carrying amount on the books is $400. Step 2, the tax base for the tax office is $360. Step 3, the temporary difference is $40, right? 400 minus 360. And finally, Step 4, you hit that $40 difference with the 30% tax rate, and bam, you get $12. That $12 is the deferred tax, the tax IOU that the company now puts on its books, knowing it'll have to pay it in the future. Okay, deep breath. We've got our two main clues now. Current tax and this theme called deferred tax. It is time to put these two pieces together and finally solve the mystery we started with.
And here it is, the big reveal. This is how it all comes together. The total tax number that shareholders actually see is a combo deal. It starts with the current tax. That's the estimate for this year, plus any fixes from last year. Then you add or subtract the change in your deferred tax, our little tax IOU. Those two together give you the total income tax expense that gets reported on the big financial statement.
So the answer to our puzzle is this. That single tax number you see isn't just about the cash going out the door this year. It's a much smarter, more complete number that includes both the tax being paid now and the tax that's going to have to be paid later. I know what you might be thinking. Wow, that's a lot of accounting gymnastics. Why on earth go through all this trouble? Why does any of this really, truly matter? Oh, it matters a ton. Think about it. If companies only reported the tax they paid today, they could look way more profitable than they really are. This could totally mislead investors. It could warp important numbers like earnings per share, and it could even trick a company into paying out huge dividends it can't actually afford, all because there's a giant tax bill lurking just around the corner that they haven't told you about yet.
At the end of the day, all of this complex stuff is about one simple thing: honesty. It's about transparency. It forces companies to own up to their future tax bills today, and that gives everyone a much truer, more complete picture of a company's real financial health.
So from now on, when you're looking at a company's financials and you see that line item for deferred tax, don't just glaze over it. Stop and ask yourself, what story is this number telling me? Is this company racking up a massive tax bill for the future, or is it lining up some sweet tax breaks down the line? What hidden stories about a company's future are right there waiting to be discovered?